Okay, our next question is the yield to maturity of US IG corporate bond is near the highest level of the past 10 years. Do you think it is a good time to invest the essay?
Sure. So just to quickly summarize our outlook, because we've talked about a lot of factors, but fundamentals have been proving to remain resilient, but we do expect further downward pressure. Q3 earnings estimates have fallen, but remain in positive territory. FX headwinds from a fundamental standpoint are likely to remain a key driver of the slowdown in earnings, particularly among global companies, and downgrades have started to pick up, but there are still more positive outlooks overall than negative outlooks. Related to that, the technical picture also has remained pressured. Lower supply heading into Q4 we do expect to somewhat limit spread tightening. Investor positioning overall appears pretty close to home, which has reduced a lot of selling pressure in the market. Hedging costs do continue to rise, with more Fed hikes priced in, and have been a headwind for foreign investors. But I think the key message as well from the technical standpoint is that interest rate volatility, which has kept yield-based buyers on the sidelines, and has been very highly correlated with spreads, as we discussed. So overall, where we're sitting today, valuations do look fairly reasonable, but we do think it's prudent to remain a little bit more defensive because of those factors of slowing fundamentals and continued interest rate volatility. We do think that we'll see in the near term continued spread volatility and possibly wider spreads as we enter the new year. With that said, as your question alludes to, yields are at the highest levels that we've seen in over a decade. If you can see on the chart on the right in the orange, the yield to worst on the benchmark is approached 6%. And so if you think about the longer term benefits of entering the asset class at a 6% yield, it's not a bad time to start looking at the asset class, maybe starting to allocate somewhat on the margin. We wouldn't advocate for going all in quite yet because of the aforementioned reasons I discussed of continued spread volatility. But overall, from a long-term investment or long-term holding period, we do think that USIG offers an attractive opportunity. And just broadly, the fact that yields where the yields are today, traditional fixed income, including U.S. investment grade, is finally offering that income that we've been wanting for so long, that we haven't been able to get, and that's resulted in investors having to chase down lower credit quality type investments. And so now with yields closer to 6%, you can get higher quality corporate exposure in your portfolios at much more attractive yields.
Okay, the last question is about the NNL U.S. credit portfolio. To conclude the view you just shared, how will the portfolio be positioned in year 2023?
Sure. So over the course of the year, we've tried to really kind of shift the risk profile of the portfolio to a little bit more of a defensive stance. And we've done so by using periods of spread tightening to move up in quality by reducing our overweight to triple Bs and high yield while increasing our allocation to single A bonds. And so you can see in the chart in the middle, this is the change year to date, over for the fund. And so at the very bottom, you can see the strong increase in single A by about 5% and the reduction of triple Bs. And a few rows below that, kind of in the middle of the chart, you can also see a pretty significant reduction in high yield. And so with that in mind, as I mentioned, there's been about 3 periods of spread tightening over the course of the year, late March, late May, and then July and into August. And so we've really tried to use those periods as a way to not necessarily de-risk, but change the composition of the risk to favor more high quality names over higher beta. And that's really tied to the fact that we do expect that volatility to continue. From a sector standpoint, and tying with that more defensive stance, we continue to favor financials. You can see on the top left, we are about a market weight in financials favoring the larger U.S. money center banks. As you can see on the top right, the top 10 issuers on both an absolute and active basis, JP Morgan, Morgan Stanley, Bank of America, all larger money center banks, where the fundamentals look attractive, more regulated cap structures, and so we like that play. They've also underperformed over the course of the year due to heavy supply, and so on a relative value basis, they do look attractive as well. We also continue to favor utilities, similarly keeping that defensive stance, which also look attractive versus similarly rated industrial bonds, and tends to be a little bit more of a defensive and highly regulated sector. Within industrials, a couple sectors we still favor and are overweight is technology and communications. And then we are a little bit more underweight consumer cyclicals and non-cyclicals, where rising inflation and input costs have risked pressuring balance sheets there. And then consistent with our philosophy, we will remain neutral versus the benchmark. And you can see in the table in the bottom right, the duration as of September 30th, 7.14 years versus 7.15 years. And so, as I mentioned, changing that composition of risk while not necessarily fully de-risking and favoring up in quality bonds. The move higher in yields has led to a very attractive new issue calendar over the course of the year, with attractive concessions, and so the ability to purchase some of those new issues at more attractive yields has led us to be able to out yield the benchmark significantly, as you can see, 6.15% in the table on the right for the yield to worst of the portfolio versus 5.66% for the benchmark.
Thanks for sharing the market outlook and portfolio strategy. And we hope today's Q&A session answers the questions you may have. Thank you, Hans, and wish to talk to you soon next time.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书，投资人须知。